Wealthy people make money, that way they can buy more assets. That way their assets can pay for their lifestyle. Broke people, and the majority of America, are working, that way they can make money to buy a nicer car. They're working to make money, that way they can have a bigger home. They're working to make money, that way they can have another vacation. But you're never going to be able to build wealth if you're constantly making money just to spend it. If you want to become wealthy, you have to make money to buy assets and then use these assets to actually make you money. That way you can make this money without you having to physically go to work. That way you can keep getting paid no matter what you're doing. That way next time you go on a vacation, your assets continue to pay you. When most people think about investing the money in the stock market, they're thinking, how can I find the next Amazon? But that's not the only way that you can make money in the stock market. And in fact, that's how most people end up losing money in the stock market, is because they're trying to find the next hot stock without a long-term game plan, and they're just trying to find the next way to make money quickly. And that's why the majority of people end up losing money in the stock market, even though the stock market has gone up historically over the last century, even though we've had periods of market crashes, we've had periods of recessions pretty much every decade, but yet most people want to continue trying to find the next hot trend, the next hot stock, the next hot meme stock, instead of actually trying to find the next real investment. And I'm going to break this down into 3 different categories. Number 1, we'll talk about the different things that you can invest your money in the stock market. These are things like stocks, index funds, mutual funds, and ETFs. Then I'm going to go into investing in cash flow producing stocks versus non-cash flow producing stocks. And then I'm going to go over what is your stock market investing strategy, whether it's a passive strategy or an active strategy. Let's jump into now understanding the difference between stocks, ETFs, mutual funds, and index funds. When you go out and you invest in a company like Amazon, you're investing in one individual company and you're taking on all the risk. And this is what most people think stock market investing is trying to find the next hot stock. But for 90 to 95, maybe even 98% of people, you should not be investing in individual companies, because when you invest in an individual company, you need to be keeping up with the company. You need to be keeping up with the earnings calls. You need to be keeping up with the finances of a company. You need to be keeping up with what the company is doing on the innovation side. You need to be keeping up with the moat of the company. How easy is it for competitors to come in to compete with this company? And if you're not interested or not willing to or don't have the time to do so, you probably shouldn't be investing in individual companies, because then when you see a company that you invest in go down and you don't understand what's going on, it can be much easier for you to panic and sell, or it can be much easier for you to go in and buy because you keep hearing the stock go up. And this is where now understanding if you are interested in actually doing all that work and taking on that risk, because the reality is when things are good, you get all the benefit. If Amazon takes over the world and you own the Amazon stock, hey, you're going to make a lot of money because the Amazon stock is going to go up. But if the CEO of Amazon drives the company into the ground and they go bankrupt, you lose all of your money, because now your money goes down to zero. And that risk can be a really hard pill to swallow for people, especially when things are going down, but it's very easy to understand when things are going up. But the alternative is, instead of investing in an individual company, you can look at investing in a fund. What are these funds? Well, you have index funds, ETFs, and mutual funds. The way that index funds work is these are what are considered passively managed funds, meaning they give you exposure to a certain group of stocks which is managed by a computer, which means that the fees that you pay on these funds are significantly lower than when they're managed by, say, a person. So there are index funds that give you exposure to something like the S&P 500, which is a group of the largest 500 companies on the stock market. And if one of the companies in this fund starts to struggle and they're no longer one of the 500 largest companies, a computer can kick that company out and put a new company in. That way it's all automatic. So you have index funds that can give you exposure to many different types of funds, like the S&P 500 is one. There are index funds that can give you exposure to the Dow Jones. There are index funds that can give you exposure to the NASDAQ. There are index funds that can give you exposure to healthcare stocks. There's a lot of different types of index funds out there, but these are generally passively managed, so the fees are less. The second thing about index funds is that there are restrictions to how often an index fund trades. So if you wanted to go out and buy the Amazon stock, you can buy and sell that stock in a second. Versus with an index fund, they generally only trade one time a day. This way, you don't have that same volatility, and you can't have people just buying in and out of index funds. You can buy it or you can sell it once in a day, and that's it, because these are long-term investments. And the third thing you have to understand about index funds is that they generally have minimums of how much money you need to invest in order to purchase an index fund. It might be $500, it might be $3,500, it might be $5,000, where you have to invest a certain amount of money in order to own an index fund. A mutual fund works kind of like an index fund, except mutual funds are generally actively managed. So now, instead of having a computer manage and create the algorithms, with a mutual fund, you generally have a person, a money manager, who is working to try to beat the market. Now, this might sound good in theory, but many times this higher fee is not going to justify the returns that you get. Because what we've seen happen over the last decade, Moody's did a study, and they found that about 75% of the time, a high-paid money manager managing the mutual fund did not outperform the market. Meaning, if you just bought a low-cost fund, you would have gotten a better return after factoring the fees. So, is a mutual fund ever worth it? No. Just understand that the higher fees are going to make it less attractive, so you want to pay attention to the fees. Mutual funds also trade generally one time a day, and they also generally have a restriction on how much money you need in order to go out and buy a mutual fund. Then you have ETFs, which are kind of a hybrid between index funds, mutual funds, and stocks, because ETFs can be either passively managed or actively managed, just depending on whatever the ETF is. But the big difference between ETFs and index funds and mutual funds is that ETFs trade just like stocks, meaning you can buy in and out of an ETF as many times in a day as you want, because they trade just like stocks. So if you want to buy an ETF in the morning and sell it in the afternoon, you can do that. And generally, ETFs don't have minimums of how much money you need to invest if you want to actually own an ETF. So what is the right thing for you? Well, this just depends on what your goals are and what you like. Me personally, and I can't tell you what to do, you got to always do your own due diligence and never blindly trust a random guy on YouTube. Don't do what I do. I'm just telling you what I do. I personally like ETFs because they're the most convenient and they're easy for me to purchase and they're easy for me to sell. And I like that convenience factor with ETFs. So for me, I like ETFs. But this is where now you have to understand, what is your goal when you invest your money. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.